could have pushed them to 27s for next week and you could have gotten more gains like that. Yeah, I know I could have, but I had a couple of other positions that I wanted to cycle that cash into, and I just wanted to keep the ball rolling. I didn't necessarily want to roll because, again, to my earlier point, I am treating this as a business. If the shares get called away, then they get called away. And the result is I get $463 in premium, and I also get about 16 or 17% return on TSLL. So the total gain I got on TSLL was $5,400. As you can see, if we add up these two numbers, 1770 plus 3630 is going to yield us $5,400. And if we add the premiums together, that's about $6,000 earned income through TSLL. However, here's the negative of this strategy is you leave money on the table and there's opportunity cost. So if we add up these amounts, because TSLL closed at $27 and I gave them up at $25, that means that I left about $2,500 on the table. Am I sad about that? Not really. Could it have been prevented? Absolutely. I could have just rolled out my TSLL for next week and deferred that further. But for me, I was okay to lock in that gain and I was okay for that premium. So I didn't really want to roll it. And one of the reasons why is because the NAV erosion on TSLL is something that's been hurting me. When Tesla falls, TSLL falls disproportionately. And as a result, it takes them such a higher effort to get back to break even. And I think the best highlight of this is look at the year-to-date numbers between TSLL and between Tesla, because TSLL is supposed to be a 2x leverage on Tesla. And so you'd imagine that, if Tesla were to go up year-to-date 50%, TSLL would be up 100%. But because of this discrepancy with the NAV erosion, that's not what you have. So here you have Tesla that's up 56% year to date. And then TSLL, by contrast, if you look at the year to date numbers, that's only up 87% year to date. And so 56%, you would imagine that it's up 112%. That's not the case, right? It's up only 87% because the falls are much more aggressive on TSLL. And so for myself, I didn't want to hold TSLL for a long time. I want to hold it to ride that momentum upwards in a very short period of time and eventually let that go. And so that's what I'm doing. Did I let it go too early? I think that's a real conversation that you could definitely make a case that I did. Should I have rolled it? Maybe, but I'm okay with letting it go. Anyways, that I think is the flip side of having this strategy, is that sometimes you will get shares called away if you're okay with that. If you're not, then you have to babysit these shares and roll them into the future. But if you're treating this as a business, then you shouldn't be afraid of shares getting called away, because that's what you're running the strategy for. Moving on down the list, I also wrote a covered call on Tesla when I was at 355 on Monday. I opened this exactly the same time as I opened the TSLL positions, except with this one, I went ahead and I closed it out on Wednesday for about 80% profit. I looked at the TSLL, they were about 70% profit, and I didn't close them out. I just let them ride, and eventually they got called away. Again, because I was okay getting my TSLL called away because of that NAV erosion, and because I have other positions that I want to cycle that money into, which I'm going to talk about in just a second. But that core Tesla position, I did not want to get called away because my cost basis on that is much lower than we are right now. Let's just put it that way. And I got $105 for that after you subtract out the cost of buying back that covered call. Moving on, the rest are cash secured puts for the most part. So you had a Rocket Lab cash secured put on Monday at $22 strike price when Rocket Lab was trading at $25 a share. I got 30 cents in premium there, and I collected $300, so about a 16 delta for that move. I did HIMS cash secured puts for $28 when HIMS was trading at $31.50 on Monday. Monday was a red day, so I was pretty happy with writing most of my stuff on Monday. I collected 27 cents in premium on HIMS, which resulted in $261 after fees, less than 1% of what I was looking for. So again, it's more or less 1%. Lemonade, I wrote these on Monday for $43 per share when Lemonade was at $46.82. Collected 80 cents on those, a whopping 80 cents for a 15 delta. That's insane to me, right? Because on Rocket Lab, it's a 16 delta, and I only collected 30 cents. But at the same time, I only wrote 3 of those. I didn't write too many because I wanted to be conservative and actually play it safe, because it was only Monday. If the market continues on a downfall for the rest of the week, I don't want to commit all of my collateral capital on Monday and then sit on my hands for the rest of the week, right? I want to have more dry powder in storage for me to be able to have flexibility and maneuver. So I wrote only 3 cash secured puts there, even though they yielded me about 1.69%. on my risked capital, $237 on Lemonade. I also did it on the minor, so on Marathon and CleanSpark on different days. So I did Marathon on Monday, cash secured put for $22, got 33 cents in premium there. Again, similar delta here, 16 delta. And I collected $323 there, about 1.3% for $22,000 in collateral. On Tuesday, I did cash secured puts on CleanSpark because CleanSpark was down after reporting earnings. And I caught this right at the bottom. I did $12 strike when CleanSpark was at $13.30. I did 15 of these contracts at 20 cents each in premium, and I collected $289 here for $18,000 risked, about 1.45% return on risk capital. Now, on Tuesday, I wrote another batch of Lemonade because Lemonade was falling and it fell down to $45.19. And I wrote 5 cash secured puts at $41, and I collected 55 cents in premium there for a 17 delta. And I collected $271 there, 1.2% for $20,000 in risk collateral. So as you can see, I was tranching out Lemonade. Lemonade was at $47 and I wrote 43s. And then Lemonade fell to $45 and then I wrote 41s. Because if my 43s got breached and if Lemonade kept falling, then I would have different tranches or different areas where I would essentially have checkpoints of getting hit. But also by doing that, if I didn't get hit, then I collect way more in premium because that's the situation. And so I've been doing that for a couple of rounds now for stocks that continue to go down throughout the week. And because I'm doing weeklies, it's just more beneficial to me. Sometimes if it's the Wednesday though, and I don't get good premiums for Friday, I'll write for the next week. So I'll write for, 7 days out essentially. And that's just me trying my best to be safe. Where this week, for example, I only deployed about 60% of the capital that I just had sitting on the sidelines, just in case we had some other weird events. And so that 1% return per week is more like 0.5% on my total cash on the sidelines, because I'm not deploying all of it at any given time, because I don't want to be too risky with it, because if it continues to fall, then I won't be able to capitalize on that. So I'm just playing tranches that are safe, 15,000, 25,000 at a time. And then as it keeps falling, then I deploy more and more. In the case of Lemonade, I only wrote 3 cash secured puts to start with, and then I wrote 5. And then if Lemonade were to fall more, I would have written 10, and so on and so forth, so as to lower that cost basis if I do eventually get hit. Now, moving on down the week, on Tuesday, we had a rally and Marathon went up at $25.36. I wrote 5 covered calls on Marathon for $28. These actually got breached on Thursday, but then Marathon fell back down and closed off the week at $26.43. I got 23 cents in premium for those for a 16.9 delta, and that yielded me about $111, about 0.88%. And I also did covered calls on CleanSpark because that also bounced back on Wednesday at $14.50. I wrote covered calls for $20 per share, but I wrote them for next Friday. So these ones are still open, and I'm not counting this. I got 14 cents in premium here, about $119, about 0.91%. Again, I'm not counting this because this is still open. This could still get hit. I could get the shares called away, or I could just collect that money in premium. I could close that out. We'll see what happens next week, honestly. So in total, I made about $2,653 in cash stick, so premiums of trades that have closed. And I have about $119 in premiums of trades that are still open with this CleanSpark trade. I also locked in capital gains of $5,400 on TSLL. Now, next week, I will have more cash to deploy. And some of the plays that I'm looking at for next week are potentially buying NVIDIA and writing against NVIDIA and covered calls. Broadcom also has earnings on Friday, so I'm thinking maybe cash secured puts on Broadcom for a small amount to take advantage of the downside because the premiums are going to be higher because of implied volatility. And then also just the usual suspects, right? CleanSpark, Marathon, TSLL or Tesla if it falls, Lemonade, HIMS because their premiums are amazing and I'm okay owning both of those. Some other possibilities for myself that I'm always open to. Celsius is getting interesting here. I think, in December, there's going to be more tax loss harvesting that can potentially bring that stock price down. So I'm potentially looking at Celsius. Enphase, I was also looking at writing Enphase $66 cash secured puts for next week. I didn't end up doing it, but I might this week. So we'll see. I think if we see a dip on Enphase, I will enter through cash secured puts, or at least write them. And then Rocket Lab is also interesting, right? I wrote 22s and didn't get assigned for this week. I think that if we see more weakness in Rocket Lab, then I might do more, simply because I think the premiums are really great for these companies. And so we'll see what happens there. And then it goes without saying that if I can't really find any good deals out there, then I'll probably just go into QQQ for a couple of days just to collect something while the money sits in holding. Anyways, I hope you enjoyed this video, and please let me know how I can make this series better for you. I've been trying to include more charts and more graphs to essentially plot out the profit and loss and try to have more transparency on the strategy. I mean, this is only the third video in this series, and I'm doing this strategy on a weekly basis. And just since I started doing these videos, so far we've collected over $13,000 in premiums, which has been just all documented. Of course, that doesn't include the actual capital gains that we've locked in for, shares like TSLL, for example. That would add up to much more than that amount. But let me know what you think, and I'll make the adjustments accordingly. I really, like I said, want to get more into options, and I'm excited to share these updates with you because I think that it's just a learning experience, right, for a lot of people, and also myself included, just to walk through some of the ideas and talk them out and have a sounding board essentially through you guys. So if you want to see more of these videos, let me know. And if you want to see changes to the update next week, also let me know that too. For right now, thank you so much for watching, and I'll see you in the next one.
This single equation spawned 4 multi-trillion-dollar industries and transformed everyone's approach to risk.
Do you think that most people are aware of the size, scale, utility of derivatives?
No idea.
But at its core, this equation comes from physics, from discovering atoms, understanding how heat is transferred, and how to beat the casino at blackjack. So maybe it shouldn't be surprising that some of the best to beat the stock market were not veteran traders, but physicists, scientists, and mathematicians. In 1988, a mathematics professor named Jim Simons set up the Medallion Investment Fund. And every year for the next 30 years, the Medallion Fund delivered higher returns than the market average. And not just by a little bit. It returned 66% per year. At that rate of growth, $100 invested in 1988 would be worth $8.4 billion today. This made Jim Simons easily the richest mathematician of all time. But being good at math doesn't guarantee success in financial markets. Just ask Isaac Newton. In 1720, Newton was 77 years old, and he was rich. He had made a lot of money working as a professor at Cambridge for decades, and he had a side hustle as the master of the Royal Mint. His net worth was £30,000, the equivalent of $6 million today. Now, to grow his fortune, Newton invested in stocks. One of his big bets was on the South Sea Company. Their business was shipping enslaved Africans across the Atlantic. Business was booming, and the share price grew rapidly. By April of 1720, the value of Newton's shares had doubled, so he sold his stock. But the stock price kept going up. And by June, Newton bought back in, and he kept buying shares even as the price peaked. When the price started to fall, Newton didn't sell. He bought more shares, thinking he was buying the dip. But there was no rebound, and ultimately he lost around a third of his wealth. When asked why he didn't see it coming, Newton responded, "I can calculate the motions of the heavenly bodies, but not the madness of people." So what did Simons get right that Newton got wrong? Well, for one thing, Simons was able to stand on the shoulders of giants. The pioneer of using math to model financial markets was Louis Bachelier, born in 1870. Both of his parents died when he was 18, and he had to take over his father's wine business. He sold the business a few years later and moved to Paris to study physics. But he needed a job to support himself and his family, and he found one at the Bourse, the Paris Stock Exchange. And inside was Newton's madness of people in its rawest form. Hundreds of traders screaming prices, making hand signals, and doing deals. The thing that captured Bachelier's interest were contracts known as options. The earliest known options were bought around 600 BC by the Greek philosopher Thales of Miletus. He believed that the coming summer would yield a bumper crop of olives. To make money off this idea, he could have purchased olive presses, which, if he were right, would be in great demand. But he didn't have enough money to buy the machines. So instead, he went to all the existing olive press owners and paid them a little bit of money to secure the option to rent their presses in the summer for a specified price. When the harvest came, Thales was right. There were so many olives that the price of renting a press skyrocketed. Thales paid the press owners their pre-agreed price, and then he rented out the machines at a higher rate and pocketed the difference. Thales had executed the first known call option. A call option gives you the right, but not the obligation, to buy something at a later date for a set price, known as the strike price. You can also buy a put option, which gives you the right, but not the obligation, to sell something at a later date for the strike price. Put options are useful if you expect the price to go down. Call options are useful if you expect the price to go up. For example, let's say the current price of Apple stock is $100, but you expect it to go up. You could buy a call option for $10 that gives you the right, but not the obligation, to buy Apple stock in 1 year for $100. That is the strike price. Just a little side note, American options can be exercised on any date up to the expiry, whereas European options must be exercised on the expiry date. To keep things simple, we'll stick to European options. So if in a year the price of Apple stock has gone up to $130, you can use the option to buy shares for $100 and then immediately sell them for $130. After you take into account the $10 you paid for the option, you've made a $20 profit. Alternatively, if in a year the stock price has dropped to $70, you just wouldn't use the option, and you've lost the $10 you paid for it. So the profit and loss diagram looks like this. If the stock price ends up below the strike price, you lose what you paid for the option. But if the stock price is higher than the strike price, then you earn that difference minus the cost of the option. There are at least 3 advantages of options. One is that it limits your downside. If you had bought the stock instead of the option and it went down to $70, you would have lost $30, and in theory, you could have lost $100 if the stock went to 0. The second benefit is options provide leverage. If you had bought the stock and it went up to $130, then your investment grew by 30%. But if you had bought the option, you only had to put up $10, so your profit of $20 is actually a 200% return on investment. On the downside, if you had owned the stock, your investment would have only dropped by 30%, whereas with the option, you lose all 100%. So with options trading, there's a chance to make much larger profits, but also much bigger losses. The third benefit is you can use options as a hedge.
I think the original motivation for options was to figure out a way to reduce risk. And then, of course, once people decided that they wanted to buy insurance, that meant that there are other people out there that wanted to sell it for a profit, and that's how markets get created.
So options can be an incredibly useful investing tool. But what Bachelier saw on the trading floor was chaos, especially when it came to the price of stock options. Even though they had been around for hundreds of years, no one had found a good way to price them. Traders would just bargain to come to an agreement about what the price should be.
Given the option to buy or sell something in the future, it seems like a very amorphous kind of a trade. And so coming up with prices for these rather strange objects has been a challenge that's plagued a number of economists and business people for centuries.
Now, Bachelier, already interested in probability, thought there had to be a mathematical solution to this problem, and he proposed this as his PhD topic to his advisor, Henri Poincaré. Looking into the math of finance wasn't really something people did back then, but to Bachelier's surprise, Poincaré agreed. To accurately price an option, first you need to know what happens to stock prices over time.